All right, welcome everybody. Welcome again to another ConsenSys Cypherpunk workshop. We are here today with Clemens, and he's going to be going over crypto and DeFi custody best practices. We're really excited about this workshop. Just a quick, I'm Shay. I forget to introduce myself every time. But a quick housekeeping about CrowdCast, which this is the platform we're on right now. On the right-hand side, you'll see there is a chat area. So feel free to chat away in that sidebar. That will be ongoing during the workshop. But if you have questions, what we ask you to do is to go ahead and add them to the Ask a Question queue at the bottom there. You can see there's already a question in there, so there's a little orange bubble. You can upvote questions that are in there. That gives Clemens an idea of questions to give priority to answer. I'm sure he'll get to all of them, but it's a great way to queue those up while he's doing the workshop. And then when he has a moment to pause and check and see if you have questions, he can quickly grab those from that queue. Also, we have a poll. And if you have a chance, if you haven't already, please answer that poll. That gives Clemens an idea about, how to focus the content today. Also, we want to let you know that there's a green button at the bottom that says see other workshops and sign up for the hackathon. So this is going to be where you can check out the Confluence doc that lets you see all the other workshops that are available, which there's a bunch and they're great. All of them are free, of course, to register. And we paste them so that you could essentially attend each one if you'd like. They're also on our ConsenSys Hackathon 2021 Slack channel, which if you join there, you always get the latest and greatest. We'll post replays of these, as well as new workshops to RSVP. Speaking of replay, these will be available immediately after each time they air at the exact same link. So if you want to watch a replay of this one today, you just come back to this same link. Same with all the other workshops. And if you're interested in asking your question on stage, excuse me, that is an option. So go ahead and in your question, just write in parentheses, Mike. And that means we'll bring you up on stage when Clemens is answering the question, if you'd like to. No pressure. So without further ado, I'll hand the mic over to Clemens.
Thank you, Shay. And thank you for organizing all of this. There's a lot of great presentations. Looking forward to other workshops. Okay, so for those who don't know me, my name is Clemens Wan. I'm a solutions architect with ConsenSys for 2.5 years. I'm officially within the marketing team under sales enablement, but I still get engaged within solutions architect work. So my background is in electrical engineering, machine learning. I have a master's at Cooper Union and kind of went off and did some early AI studies with robotics, and then went into finance after that for 6 years. Within those 6 years, caught the blockchain bug at some point. And then joined R3 shortly after that, where I spent 2.5 years working with the consortium members. So I know a lot about different use cases, know a lot of different innovation group bank members. I'm personally really enthusiastic and passionate about DeFi in general. I call myself a tech philosopher because, even though I tinker a lot and build a lot, I do like just talking about the future of tech. For those who know me within kind of ConsenSys, I do share a lot because I like writing, I like brainstorming. I have a thing called Lists of 30. It's a process that I use for just exploring different things, just kind of getting my mind mapped on certain subjects. So I blog at clemens.com, and I'm a podcaster, if you couldn't tell from the mic, at listsof30.com. So thank you everyone for joining. Today, I will be reviewing some security good practices, and I did attend Anthony's initial session. There is a poll that's supposed to come up at some point asking 2 questions about whether or not you attended Anthony's session or Corbin's session, but this will be, I guess, a 201 of those sessions.
Did you want me to read those now, the results now, Clemens, for the poll?
Sure. I didn't see the poll.
Oh, there's new polls. Okay, gotcha. You do have one question that says, do you currently hold crypto? And most of the people answered yes, just so you know.
Okay. I sent 2 separate questions, but they're mostly just checking to see if people attended Anthony's or Corbin's session, but that's okay.
Okay, I'll add those in now while you're talking, and then everybody will have a chance to answer that while he's going through the workshop stuff.
Sure. Well, I'm just going to jump into it. So the main takeaways are similar, which is protect your seed and secret passphrase, all of those good things, never share it. No one's going to ask you for it. And even people within ConsenSys, as well as DeFi is super interesting and it's worth taking a look. Fees are super high today, so I might not do any hands-on experimentation, or else it'd be a very expensive session. Also, if this is shared with other people, I don't want people seeing my different segregated accounts. So I'll keep that separate, but I do have a way to have people play around with different DeFi dashboards. Okay, just to kind of give this disclaimer, is that I created this material and it's not an opinion from ConsenSys, and I do advocate about learning digital security practices as well as participating in alternative assets. This isn't to pump any type of asset. It's just to understand the properties and design patterns that I've seen. And certainly this is not investment advice. So hopefully that covers me on a legal side. Just to go through this, I'll do a high-level overview of the levels of security that I've thought about, as well as levels of DeFi participation, some thoughts on investment philosophy that I've put together. Then I'll walk through each of those levels with different good practices. Then I'll go through some hands-on DeFi exploration and some final thoughts. So these things happen, right? Don't be a statistic of being hacked. Tanya was nice enough to agree for me to share this from the Slack channel where she was hacked in some way just by sharing her phrase. And because we have such a great community, asking this within our team, getting help is also useful. So having these lessons learned are super useful. Some of these are not direct hacks. Obviously, Ethereum has some smart contract flaws, but overall the chain is not being hacked in any ways. Most of the aspects here, especially if you look at the best precautions that are taken, the hackers that are creative are very patient and they wait quite a bit. So if you have, inadvertently downloaded malicious material, they can make some changes, and that has less to do with the software, more to do with kind of social engineering hacks. It's good to learn about these postmortems and to see how it impacts the ecosystem. I think the best practices overall should be learned if you're in a non-custodial world, as well as if you start, with different types of exchanges, you should work with a reputable one that's likely not going to go under or run away with your funds. Okay, so I'm going to walk through these in a lot of detail, but this is how I've mapped it out. On the bottom, there are general digital security best practices that help you avoid different types of phishing and scams. I'll talk about each of these in heavy detail, but just as an overview, it'll walk through these high-level tasks that I think everyone, even if you're not a crypto user, should do. Then I'll talk through different ways of getting exposure, first through CeFi, then through self-custody, and then aspects of self-custody layers of security that you may want to consider adding. Most investors get access to different types of cryptocurrency in different ways. I wrote a list of 30 about this, but you can either do direct exposure or indirect exposure. I've seen with indirect exposure, directly using either a crypto exchange, CeFi, or using a traditional exchange like Robinhood to purchase spot, right? So spot is just pure cryptocurrency. You can also use PayPal, but that's even more lock-in than any of the other ones, because I don't know if you can do any type of exit with PayPal. Maybe the stablecoin is different, but who knows? From there, you can also think about issuing your own tokens. That's not too hard to do, but later I'll discuss tokens of value have network effects and require the right participants, liquidity providers, support from infrastructure in order for it to be listed and have value. You can also buy your own mining operations. Maybe you own a dam somewhere and you want to run your natural gas, electricity, and the spare cycles with mining. Not recommended, but it's possible. You can also trade futures contracts. There's quite a few that leverage and margin times multiples. Short versions of it, the Doge Bear has done quite well recently. There's different types of contracts that are available, as well as derivatives associated to that. You can stake your tokens, you can do yield farming or liquidity farming, and work through DeFi protocols, which I'll work through later today. You can also work through asset management services. So portfolio balancing to me just means taking off risk or kind of rebalancing the token exposure. You can also buy through Grayscale, which I know a few people might have done. They're just packaging in traditional financial services methods. The indirect exposure, I think most people are working on something similar to this, which is you're investing in people as well as in projects rather than just buying spot price. So you can indirectly build a partnership network of some sort, build adoption for crypto spending or utility, partner with different interfaces, build different components, and the ETF through that's coming through as well. It probably led to the price boost with ETH, but there's probably going to be an index of companies that reflect crypto exposure. I also think that most institutions are getting more exposure by putting it onto their balance sheets. Hopefully it becomes a metric in kind of VC valuation for base of the company. I don't know if different companies expose that they own gold or different types of commodities, but it could be an aspect to own enough ETH to execute their particular visions. This is Corbin's version of getting started, which covers stablecoins, trading tokens, lending, all of these different aspects, and going deeper and deeper into different layers. I would highly recommend watching Corbin's DeFi 101 if you haven't already. It's going to be a different take from my part, but we're going to cover similar material, obviously. So my version of this is something that I actually brainstormed on a writing circle call with Anthony and Joshua. And we were just going through how different parties can participate in DeFi, starting with different safest versions, right? Things that will likely not lead to impermanent loss or any type of exposure that's kind of going to break the bank in any way. Then you may get started with some easy interfaces, with some direct spot swapping, reading of different white papers, maybe understanding of that aspect. In more advanced, you may go into trading NFTs or ETH2 staking or working with Pool Together. And then if you kind of get to the next point, you may start fractionalizing your NFTs or participating in DAOs directly, or doing something that I call protocol lobbying, which is just buying governance tokens and paying attention to the different voting associated to it, as well as maybe customizing and building out different platforms. I think this is important to think about is the diversity of your overall investment exposure. And so this is just a personal, I've written a few blog posts about this myself. I consider everything that's high risk, high reward as gambling. And so things that I've gambled with and kind of admittedly not just checking prices all day, but just kind of understanding the market and kind of having skin in the game. I do options trading to try different YOLO ideas. Thought about meme stocks, was a part of Wall Street Bets and kind of went through that phase. Have my share of shitcoins and my share of yield farming involved. Experimenting with different platforms in order to get airdrops, also funding different startups that I've seen. On the conservative side, 85% of my investment I don't touch. It's mostly long-term allocations that I've done either through staking or through real assets or through long-term private market shares. And there are different ways of securing these. So I just want to give this perspective because I think a lot of people are trading with things that should be investments or should be long-term instead of considering what's actually gambling and short-term, and maybe not the best use of your short-term time, but definitely a fun thing to do. Okay, so let's go into protection. So this is security level 0. So do this even if you're not in crypto. The first thing that I do is I have multiple email addresses that I've segregated and separated, and I also use temporary email address services. And some people might not do this, but it's a good idea to do this. If you have just one email address for everything, it's a little bit insecure. The reason for this is if your one email address is compromised, then your other activities connected to it can also be compromised. You can do recoveries, they can lock you out of your account. So I have separate addresses for signing up for different social networks. I have a professional one that people may know. I have, ones that I use for signing up for newsletters. I have a separate one for bank accounts or any services that deal with money. There is a recovery account of some sort. I do one for donations because a lot of spam comes with it, and it requires you to enter your address and all these other things. I try to unsubscribe to as many physical mails as possible, but that doesn't happen. Anything related to crypto, I completely have segregated accounts for, also for research and also for general experimentation. If I'm using Product Hunt or things like that, everything is kind of split out. And the reason for that is I don't know who's sharing my data or who's selling my data. So it's probably a good idea to not just use one email address for everything. It's also a good idea if it's a small startup that might not be fully secure to not just use your email address, or definitely not use the same passwords that you might have. Another thing is to not be a target. So I love joining communities, but I use kind of masks, different ways to kind of mask myself, just to prevent any type of spamming or phishing, especially my phone number. I don't usually list it in the different accounts that I have. I actually have a burner phone that I use for looking at most of these things. And the thing is that, most hackers look at these targets and they program different bots to just scrape across multiple channels. So you might be in a Telegram channel and it could be even like ETH Denver, and you might get random messages from people. And if you start responding, then it's kind of part of the social hacking that gets done. Different Facebook groups, different people that you follow on Twitter, different accounts that you participate in. I have completely limited all of it, right? Because I don't want to be on any of those lists. Even if I do follow someone, I try not to do it from a main account of any sort. It's definitely separated from the photos that I post of my daughter or things like that, right? It's, even within LinkedIn, following different groups that you may get friends of friends of friends getting added. I'm very selective in who I add into my circle because I know that it could be a large risk. And definitely same for Discord. Make sure you have separated accounts, separated by different email address logins and all of these things. Definitely use 2FA. It is annoying, but multi-factor can save your butt in many ways. If your actual password gets hacked, try any of these, use all of them. It doesn't matter. Most people use Google Authenticator. I like the push notifications that come from Authy and Duo. It's up to you. I think that it's better to use a 2FA rather than using your phone, because and we'll visit this later, if you get SIM swapped or if you get your number ported, then you definitely would have these aspects. I also protect my phone very dearly. I don't kind of just leave it around because there's a lot of information on it. So definitely keep that in mind. Also, and this was emphasized from Anthony's, his webinar mentioned kind of these different password managers. If you're still using a notebook where you write your passwords in there and it's not just seed phrases, then I don't know what you're doing. If you're keeping track of all of the hundreds of thousands of sites that keep your data, and you have to figure out how to rotate different letters and numbers for each one, and it's all in some paper form, then that could be pretty bad. I have set this up for the whole family. It's also important to keep your other members of the family safe, because there are weak links. And even if you're very aware of this, definitely encourage people. There are family passes associated with LastPass. There's all these other aspects of it. Also, if possible, allow your password manager to do auto password rotations, which they can do pretty easily. You have to accept it for every single one. But once you get started with this, and once they figure out the history of what you've logged into, you also can delete accounts that you don't use anymore. You may see different 2010 types of websites that don't exist anymore. So you try to archive those accounts and rotate those accounts. But the key idea is that you have a single passphrase. Yes, it's a single point of failure, but it's more or less easier to protect one master passphrase and apply all of the different factors to recovery and to limiting the authorized IP addresses and the authorized, even MAC addresses for access to them than it is to cover all your bases across the hundreds and thousands of sites that you may be signed up for. I don't personally use browser-based password saving. That's because, again, if my whatever Google account was hacked, then I don't want all the passwords being hacked as well. So, yep, any of these work. I believe Anthony showed LastPass that has a note section. So if you do want to secure notes through this way, this is just a way to segregate. So create passwords that are very, very long. Try, larger than 50 characters if possible. Yes, it's annoying to type it out, but do long phrases, do replacements. Anthony recommended the kind of mind map of walking through your house and seeing different items or kind of objects and then putting them together. It looks a lot like a 12 secret, passphrase that you have for MetaMask. So maybe that's a good strategy, is you have those 12 words in those orders and something similar to that. Cool. Another one, and this might be simple, but also avoid SIM swap attack vectors. So call your customer support and tell your telephone service provider to specify no number porting. You can also create Google phone numbers. I have a bunch of them. If you want to give one away, then give that Google phone number rather than your regular phone number. Also, I never use my phone number for 2FA. I kind of want to avoid and kind of segregate that account as well. And I also don't join any chats with my phone number. Joining through Telegram, giving people access to a username is better than giving people your phone number, because then they can spam you, then you can get a bunch of other unwanted calls. So highly recommend you do this, to call your service provider. The other one is kind of a bonus, which is my phone is my identity, right? I don't leave it lying around. I don't join any insecure Wi-Fis in public places when I'm traveling. I do use a VPN. I turn off the screen within 5 seconds of inactivity, require everything more or less. I clear all the caches. I'm very aware that latest, whichever keyboard software that you use keeps track of all of your clipboards and keeps track of all of your typed in things, and crawls your emails to make sure that you get kind of the best prediction analytics, and all of those things seem very insecure to me, so I don't do that. I don't download apps. If I do, I use my burner phone. If you want to experiment, get a burner phone or just a tablet. Don't log into the same account, use a different account. This is just kind of base security that I've done to protect myself, and recommended for anyone that's has anything to lose. Maybe it's less likely if you don't care that your Facebook gets hacked, and some people can. Maybe it's just reputational risk at that point. But I would just say doing any of these things makes you less of a target, and therefore the people that don't do these will get hacked first. Not necessarily being fully paranoid, but it's not expensive to get another device. It's not expensive to segregate these accounts. And if you're just starting now, then it's also free to create new email addresses, and it's free to go through all these different steps. So definitely recommend doing it. Having a dozen email addresses may seem weird, but it's actually a good practice. Okay, so let's go into institutional custody. Again, I sign up. These fiat on-ramps are required for tax purposes. Pay your taxes, get KYC, do it properly, and I would not buy crypto exposure with any types of shady services. I would say that I sign up with all of these in different email addresses. I set up 2FA right away. If it doesn't have 2FA, I don't sign up for it at all. I use a password manager for all of it, and definitely pay your taxes. So also rotate as needed, and just do these things because it is money that's on the exchange. Do it for Robinhood, do it for your regular Coinbase or Gemini accounts. All of these are super important, especially the 2FA one. Okay, so when you evolve from CeFi, you may be exiting your cash off of Coinbase, like trends have shown, to go into your MetaMask wallet. So there are best practices here, and Anthony has gone through this as well as walk through it physically, so I don't have to. That's great. So just watch Anthony's. He'll walk through the actual creation of a new LastPass account, and then the creation of a new MetaMask wallet, and then ways to secure that wallet in itself. I have these high-level setup kind of protection backup ideas to help people walk through it. So reducing number of points of failure and weaknesses can jeopardize your account, general identity of the wallet. So try not to have any cascading issues. So I do have paper wallets. I have memorized phrases. I've secured my paper wallets in different ways. Maybe you split up the phrases. Maybe you place them in different places, and then maybe you kind of throw them around and post them everywhere. I don't know, but try to keep these secure and try to maybe encrypt them slightly. Maybe it's word association, maybe it's not, but don't get too complicated, or else you might just mess up the phrases altogether, and it might be just way too much security to, put different items and then take a picture of it. I don't know. That might be too hard as well. Definitely don't just take a picture of your seed phrases, because they'll store it to the cloud and throw it everywhere. And if your Google account or Apple account is jeopardized, then that picture will basically reveal your entire wallet. Also, don't just copy it into your Notes app unless it is your LastPass or whatever Notes app that's secured in its own way. Also, don't just write it in an email address and email yourself those phrases, because again, if your email gets hacked, and this is alleviated by segregating your accounts, by having multiple accounts. If one gets hacked, then hopefully it doesn't cascade to other ones as well. Definitely get a cold storage option of some sort. Ledger Nano. I think this would be really cool if ConsenSys could have a partnership with one of these companies to kind of give it as a base. It is expensive, but it's well worth the investment. So for those who don't know, cold storage options, hardware wallets, are keys that have encryption on it that are needed to sign before you can actually execute anything from your hot wallet. So it's just that extra layer of protection that lets you sign these transactions and lets you secure it in an additional way. So you can run around and just have your balance on a cold wallet if you want to. Buy it from a trusted provider. I trust Ledger and Trezor. I don't know any of the other ones, so I'm happy with buying those. And remember, this takes weeks to ship over, so buy them soon, buy them early, and apply them to accounts that may be used for investment and not for gambling. For the gambling ones, maybe it's okay to lose that amount, maybe it's not, but this is well worth the investment for additional securities. You'll probably pay more in gas fees than you will in securing this. Also, I do have my ENS set up as Clemens.eth, but I do not store any funds on it. I just don't want to. It just doesn't seem like a good idea to me. So once I've used it for sharing with people to send funds for me for a project, and then I just drained it pretty quickly. So it's not a honeypot. Same for multiple domains. I don't like the idea of keeping this separate. Okay, so you can also have multiple wallets or multiple accounts within wallets. So your MetaMask is a wallet in itself, right? That is backed up by your seed phrase, but you can add multiple accounts inside of it. And you can import them into different wallets and all these things. You can use non-MetaMask wallets. There's a lot of choices. I have these rules personally, right? No more than X amount of ETH per account may be readjusted based on the price of ETH. I also have accounts for different types of tokens, maybe specific to governance tokens. I also have accounts that I use specifically for testing different Web3 sites. I don't just randomly use an account with a lot of money to sign into some random site that someone has built. I think that's not a good idea, especially for something like Decentraland. If you guys created a new account, that was the right thing to do. Don't sign with kind of your default account. If you do, want to experiment. And all of these are risky behaviors, but I always create new accounts. It's free to do. Right? And then also any type of NFT purchasing or anything like that, as new accounts are created with that. So accounts are free, similar to email. So if you're really paranoid, you can create multiple wallets. You can have just a hot storage wallet that you memorize all your phrases for and use that for investment. So they don't even get logged in anywhere. They're just kind of floating around, and you can send cash to it or whatnot, or send through your exchange directly to a wallet. And then that's kind of just stored as in a hardware wallet, but also in pure ethereal space, right? If you ever wanted to sign into it, recover it, then that's when you would review it. That could be a strategy for long-term investment, is just to have a hot wallet that's not signed in anywhere. That's just kind of floating around, hasn't done any transactions except for receive whatever, and then it's just sitting around for long-term investment purposes. Also, be wary what you signed, especially on testnets. So I know a lot of people play around with testnet, but the accounts match in some ways. So, use different accounts as well in testnet. Just create new ones. I would say that everything is really important to double check. So whenever I send transactions, I open up the Etherscan address. I make sure general spot check of things that are real. There's just, even though whatever transactions you've sent has already been sent, it's good to know ahead of time. Those extra hours could be super important. Also, I do the same thing that I do with sending money in real life, right? I send small amounts and then make sure people get it, and then send larger amounts. These are just kind of different strategies that you can have for authenticity, for making sure you're not just, sending $1 million at once or even $1,000 at once. You should try sending a smaller amount before larger amounts go through. Okay, so there's some better layers. So the idea here is to keep segregated wallets. So don't keep all your money in one place. Think about an X amount in a trusted exchange. Think about a Y amount in a hardware wallet stored in a safe location, maybe a Z amount in a non-custodial MetaMask wallet that isn't logged in anywhere with backed up seed phrases, and maybe even some money in a Gnosis safe multi-sig wallet. And these are all for investments. And then maybe your ABC amounts are for experimentation, money that you can lose and not feel awful and kind of be very sad about if you lose that money. And that's what I consider gambling. So very explicitly keep these separated for sure. Make sure your investments and your gambling is separated. Make sure that experimentation within gambling is known, that risk that it could be lost. So definitely be paranoid about it. It is money, right? It's not just magic internet money. It's hopefully going to become real value, and it is real value to me at least. So this could be a good way of consideration of how you separate your accounts, and then diversify across them as needed. But I don't know if this is investment grade or kind of the institutional grade type of custody that some people would have, but it's definitely better than just having everything on one MetaMask account and signing random keys. So definitely just don't do that. Maybe consider doing some of this. So physical storage, there are things you can store and places you can store them, and you can vary these as well. So if you do have a hardware wallet of some sort, consider how you're storing it. Consider paper wallets. Consider these steel engraved wallets that you can use actual soldering iron and create by itself. There's also passphrases for hardware wallets. So now you actually need to store within the hardware wallet additional passphrases. And all of these things can be a huge cascade of different barriers. It's like a lock box of some sort. You have other boxes of security. Imagine a physical vault that you would have, and then you have the safety deposit box inside, which has one key, but then you have secret vault locations and different lock boxes inside of them. So make sure they're all separated, and you can easily access them if you want to without any type of large mental exercise, or also just mess everything up. You might just lose everything just by not having a good system in place. But consider these types of variations for it to be a little bit more complicated. There's also social recovery. This also is available within LastPass, right? They have the social recovery inside of there. Within Argent, they've set this up because your wallet is more or less a smart contract that they can add on these different layers to. This is an option, but I don't personally trust any friends or people that I have to protect and kind of recover on my end, because there could be collusion. I don't know if they're going to try to murder me or something like that and take my money, but I don't know. It's just consideration of ways to recover. Maybe doing it yourself is better, but definitely consider, a conversation with your family members about this. And just in case something happens to you, then they know how to recover your funds or know where the information is for recovering of funds. Okay, and I know that 30 minutes was what I was allotting, and this is kind of the last one, which is the super paranoid. Depending on how much funds you have, Chromebooks or Raspberry Pis are super cheap. I like Chromebook more, although Raspberry Pi is pretty efficient. You can install your Linux servers on it and whatnot, whichever flavor you would like, Fedora Core or Ubuntu, whichever one. I just, separate through laptop or separate Chromebook, super cheap, log in with a device that's not my common email address, super easy. And then I usually uninstall, I choose Chrome, the Chrome OS over others, because within Windows, there's a bunch of spam that gets installed depending on who you buy it from, the supplier. So you can uninstall it, wipe it clean, reinstall with Linux, and then only update things that you need. Only log on with an account that's segregated, and uninstall everything else. So learn some Bash and kind of make sure you have a clean build of some sort. I've also had thoughts of doing this, but haven't done it yet, but disabling all Wi-Fi connectivity, creating a pure air gap so that the laptop's only used for transactions. And so I think about it in the idea of kind of those 90s movies where you have people wiring money transfers and they have like a metal briefcase that's, chained onto some bodyguard's hand, and then they open it and it has like a dedicated satellite line, and they type in whatever to transfer money from a Swiss bank account to somewhere else. You can go that extreme if you want to hire a bodyguard and do all those things. But air gapping is one of those ideas that you may want to go into if you have a non-trivial amount of money. This is an idea that came around through just talking to one of our colleagues. I didn't really know about it, but it does kind of make sense. So the idea here is that Coinbase or other types of exchanges have multiple ways to manage their risk and exposure, right? They have to, I think in the old days, it was like no more than 1,000 Bitcoin in one address or something like that, but they don't keep it on your actual address. And so if you send a transaction from some address to your exchange, you'll get flagged for a bunch of stuff and they know who you are. But if you wanted to then kind of have less of an on-chain structure, then you can kind of move from one account to your exchange account and then wash those transactions to a new account. So not sure when people would use this, but maybe if you're kind of afraid of people that are mining or kind of just looking at a bunch of transactions to segregate out different whale amounts or things like that. I don't know. Probably not necessary, but a consideration. Also setting up of Gnosis multi-safe, multi-sig accounts. Again, this is just another layer of who do you trust to move your funds, and if it's a lot of funds, and maybe this is something that we look into for longer investment plans or trust plans of some sort, but this is also a consideration. It just means that you've created a safe that requires 2 of 3 keys to sign, and so you have to work with other parties in a trust of some sort in order to do any type of money movement, and so you can imagine this as a literal trust that you require, your kids to sign this together, or else they can't, decide on how to use the money or things like that. And then this is a project that I'll be describing later on, but there are ways to create trusts or wills associated with your crypto. There's traditional ideas of just creating a printed and signed legal will that is floating around somewhere through some service that someone needs to know. So that could just be directly to your CeFi accounts. You could bury a treasure map if you want to. You can also create a trust that's managed by an institution. I believe some of the brokerages out there provide different trusts, and if you trust that brokerage, then maybe, but who knows. Then on the crypto-based side, I've seen people do on-chain Easter egg hunts of sorts, so just spreading out passphrases or spreading out ways to provide access. And then there's also the idea of having legal instructions associated with that that's kind of placed on chain. You can also do multi-sig with institutions, so you keep the majority of it, but you want a company like ConsenSys to help with multi-sig on releasing funds if anything happens. You can also create an on-chain trust that creates its own tokens. Maybe it's a limited supply, or it's a not for secondary market trading or things like that. There's also time contract releases that you can form. So at a certain date, you can execute a transaction that moves your money from one address to the other, and you can kind of create it as kind of like a timed contract release if you trust the oracle that's doing the actual sending of the transaction to do that timed release. And then if you want to go, pure institutional, there's functionalities that are included across these institutional crypto custody solutions. And this is an old list, I'm sure. There's traditional players that are looking into how to get exposure to this, but you basically get all the benefits of onboarding, UX for non-crypto people, additional partnerships with insurance, just different plans that might want to just skim off some cash for managing your assets. So it's an option, but I don't know, you may create better terms or better methods of safekeeping, as well as registration, as well as transaction processing. But some people like to trust a actual institution to do it rather than pure software. Okay, I know that was a lot. There's a lot of not having friends solves this issue, I guess. Yes. I'm going to now go into some DeFi exploration. So hopefully this was a little different from Anthony's walkthrough, kind of more structured into saying the specific steps that you can take for protecting your funds. Definitely do this even if you don't have crypto, but obviously get involved in crypto if you're working for ConsenSys. Just explore and experiment. So what I'm going to walk through next is looking through these different versions, and I'll just select a few that might be interesting for different folks to try out at different, varying levels of difficulty. So this is something that I don't know why people don't talk more about. The DeFi management layers that are available for non-crypto savvy users are actually quite incredible. And I didn't actually know these were evolving so quickly, but these more or less could be dashboards that you see within your commercial bank. I have a short spiel that I'll just talk about, right? So commercial banks, the ones that you have, maybe not JP Morgan because they're big enough, but maybe your credit union or whatnot has fewer and fewer funds and incentives to be kept within that space. And so, the only last straw that they have is that the money that you get from your employer directly gets deposited to some checking account, moved around to a savings account that has, 0.05% interest, and it's all crap and it's not a good idea. Maybe they have premium memberships, maybe they have deals with credit card companies. And then the other aspect is that credit cards themselves, all of your credit that you have to pay for is directly, paid through that same bank. Other than that, I don't see many people, and maybe mortgages, but not all banks are involved in mortgages. But other than that, I don't really see people using bank accounts as much anymore. You could imagine some people keeping more money in exchanges like Robinhood or Gemini or Coinbase. You could see more people keeping money into kind of saver apps, like these kind of one-click, deposit directly into the saver app, and then you'll save money, or any type of aggregating service like Mint, kind of showing across multiple accounts, being able to manage across multiple accounts. So I just think less and less money, especially PayPal and Venmo. Maybe you have large Venmo balances, and maybe you're just kind of washing old money between Venmo balances, is just kind of moving money between friends. And so you don't really need a large account there. So commercial banks are slowly dying. And I think that this type of interface for them would be super beneficial in terms of actually having an extra layer that says, this is my checking, my savings account, my CBDC account, my stablecoin amount, and then being able to take advantage of DeFi in that way. Could be super interesting. I think the barriers for that are around balance sheet management, because who knows how hard it would be for either a CBDC or an actual, stable coin added to that bank account, what that means for the overall balance structure. But anyway, all of these are open and usable now. And what I want to do is actually just walk through the DeFi Saver one, just to show people with a simulated wallet how these different structures work. And I highly recommend you just go to DeFi Saver and walk through it. What I'm going to demo is free and fully available, and something that I wish Quorum did in some ways as well, is kind of show, hey, I can create a sidechain. Within the sidechain is just a simulated account, but you can actually play around with all of these different DeFi patterns. So I'm going to walk through some of these steps, and feel free to ask in the chat. I'm going to be using, I don't know which one's the best. They all have different ways of showing exposure, and they all have, I'm using DeFi Saver because it's just a nice one that I've used before, and I kind of know the interface quite well. So the first thing that you do within DeFi Saver, you'll get started with your main portfolio, and this is a simulation, and this is not 100 ETH that I have. You can, under here on the top right, show you connect your wallets as needed, which I'm not going to do, but there's also a simulation wallet. And when you create a simulation wallet, they will give you 100 ETH as a base. And so your dashboard shows the different exposures to different types of protocols out there. So these are smart contracts that exist for simulation. They're maybe even deployed to a sidechain of some sort. Maybe not. Doesn't really matter. They probably just have some logic to show the front end of it. The prices are real though. So the pricing that they use is coming from their pricing data cache of some sort that they're feeding into this. So I think that's pretty interesting. So let's start off with MakerDAO, because it's a good way to get DAI. So a CDP is a collateral debt position. And for you to receive MakerDAO, if you already have ETH, what you want to do is create your own CDP. So an actual CDP requires collateral. So let's just put in 25 ETH with the debit. And then when you create this, just look through what this actually means. You're creating at ETH exposure with an amount of debt, right? There is a known price. There's also a liquidation price to make sure that it's fully backed. So I'm actually backing my ETH into a contract that will then mint new DAI for me. So this is just the creation of the contract. It's the first step. It's a transaction that gets sent. You see there's a DS proxy that you can do, and it shows you transaction fees and estimated fees and whatnot. So, okay, transactions being sent, which means that this particular CDP is being created. And so you accept, and you have created a CDP, which is super cool. So you first created the DS proxy associated with it with the transaction, and then the next transaction created the CDP itself. You can automate the system by adding in, and this is kind of also in real life, the liquidity protection associated with it. I'm not going to do that. And then you have these different options. So this is cool, right? Now that I have this CDP, I see the stability fee related to it. I can transfer more ETH to it if I want to. But let's look at the different actual aspects. So Boost is, I can describe a little bit later, but you can add more collateral, you can withdraw collateral, or you can kind of withdraw debt. So withdrawing debt means that I'm actually generating a minting DAI out of nothing. or out of the amounts that I've created. So I want to generate 10,000 DAI so that I can actually have enough DAI to play around with the other aspects here. So I've sent a transaction to my CDP in order to generate DAI, which just means that it knows my account, it knows that I'm here. I'm literally just using the collateral that I've created off of it, and I'm minting new DAI. And different versions of MakerDAO have improved this by just not having pure ETH. They've expanded it to wrapped, or pure wrapped ETH, but they've expanded it to wrapped Bitcoin and kind of other types of collateral. They've worked with Tin Lake through Centrifuge so that you can actually have real assets in there. And so it's just super interesting, right? You have all these different aspects related to the price associated with how much is in there. And then if you take a look at your wallet, I've actually just minted DAI off of the CDP that I've created. So now I have a DAI balance, which is cool, minus the fees that it took associated to it. I don't know if the simulation is being run on Rinkeby. It would be interesting to get more information on it. Cool.
Oh, go ahead.
Oh, no, go ahead.
I was just going to say, you have a few questions in the queue. I don't know if you wanted to go through those or if you're still in the demo.
I can answer some of these questions. Oh, I should have checked this before I moved into DeFi, because some of them is...
Well, there was one at the end that I don't know if you remember, because it was related to a slide. I think it was from Nicholas, and he was like, what was the big hardware wallet on the right of that picture? So if that's a quick answer.
I actually don't remember. I just searched for hardware wallet images, and I think it started with a K for some. I don't remember what it was.
Well, Ledger is the most known. Yeah, I think a lot of people.
Yeah, Ledger and Trezor are the most known. Mm-hmm. I think that was like the most expensive one that was out there. I can look it up in a second, but.
Okay, no problem. Yeah, so if you want to go ahead and pick the question that you'd like to answer that are queued up, since you're able to see them.
Yeah, so from John B, splitting up seed phrases, it's up to you. I don't have a pure recommendation. I do 444 rather than anything else. And they're just easier to remember chunks, kind of like remembering phone numbers, have those different dashes in between. I know my brain works in different ways. So that's a good way to memorize different combinations of chunks of phrases. ETH domain. Yeah, I don't use vanity wallets with any meaningful amount in there. So it's probably not a great idea.
And what is the benefit of, because I actually got one too, and I was like thinking, I don't even know why did I get it? So, like what is the main point of having it other than just, oh, cool, I have a .eth? I mean, I know it's easier transaction. You can say, hey, just use this instead of the big hashtag, but is that the only benefit?
This was, yes, but you also have like mini address books inside of your wallet. So whenever you send a transaction to an address on your MetaMask, you can add an alias to it. And then you just like similarly sending a wire transfer through ACH or through, FedWire or whatnot to another party, you can remember their account information. Similarly, you can do that locally, but I don't know, it seems to be an easier way to do domain linking. So this was kind of like early days in 2010, 2011. I don't know. There's different parties that tried to make this into a full business, but a lot of people start sitting on them. So they're like sitting
domain
on these
linking.
names.
And what do you mean by domain linking?
There's an old business of sitting on expensive domains so that people sell it to you for DNS. So people would get like whatever, like money.com or something, and then anyone who wants to buy money.com can sell it for a lot of money. And so I think a lot of early users to this that made money off of kind of DNS squatting have done so with ETH squatting.
But it's used differently then, yeah. Okay, gotcha. And then Anthony was mentioning, I guess it's a security risk, because he was saying, phishing, it's vulnerable to if someone gets a hold of it. I don't know. That's why I was wondering about the security of that.
I'm not sure. Also, getting a hold of it.
DNS cyber squatting. Okay, fair enough. You do have another one. It says, how do you score trust on these sites to purchase Ledger, etc., and how do you keep up to date? That's from Amal.
That's a good question. I just personally like Ledger and Trezor because they're the most common, and I know that they have a team that updates their software and that is continuously growing. I know probably most large players use those. I don't know if any large players would invest money into buying their own team to make a secret one for themselves, like that kind of the idea of that metal briefcase style setup. But if just for like plebes, you could just I would recommend just using one that you see and that you trust, which could be by the most common one.
Yeah, that makes sense. And David Clark had asked, how secure, how much confidence do you have placing platforms like BlockFi and or Celsius?
Yeah, so all of these I don't use in any meaningful way with my investment money. I actually, I trust Coinbase and Gemini because they're big enough to be around and not run away with my money.
Right.
And they also have like custody services. And so if they have custody services, they probably have insurance around it. And so I wouldn't trust even any centralized exchanges that have, not that much money in there, or use the ones that you know. And I would add Binance to that list as well, because I think Binance is fairly well established. But I wouldn't just go for like the local one that's accepted in my country type of thing.
Right. I was going to say, for a beginner or someone just starting out, you would recommend Coinbase and Gemini and Binance, essentially. Maybe those would be the good starting points for an exchange. Yeah.
Although Binance doesn't really have a fiat gateway unless they updated that, which they probably would have. But there's, they have jurisdictions that they have regulations for wherever they're formed. So they probably have a US based Binance. But within like New York, you need a bit license, and that's only available through Coinbase and Gemini and Kraken as well. I guess I would add it in there because they have a lot of ETH2 staked. So.
Okay, great. And you had also posed a question, and there were a couple answers on there. I don't know if you want to look at those answers from Nicholas and CA Pasram. It was your question about holding crypto. Which techniques do you use for security?
All of them. Use them all.
Use them all. Be secure.
Yeah. So the base minimum is don't be a target and never share your passphrase. Everything else, just don't fall for social engineering scams, and segregate your accounts so that if you lose access to one of them, it doesn't cascade into losing all of your funds. And I think the base security rules that you have for your general practice of managing your email accounts, for example, because they're kind of the crux of most recovery of accounts somewhere else, that should be minimized. And I do that through password managers and whatnot. So super useful to do that way.
Yeah. And it looks like Nicholas uses the Ledger S and X, as well as he's with paper in a water and fireproof safe. There is that option. And then CA Pasram, he mentions paper wallet and seed distribution. Okay.
Yes.
All right. Well, that's all the questions for you.
Cool. Yeah, I think security is super important. I'm happy to, work with the security team locally to present this again, or to kind of clean it up and make it kind of like a base intro that's needed for anyone in the crypto space. And I'm going to be pitching that a little bit later, which part of my hackathon project is to do a crypto HR module, which we'll talk about later. Cool. I still have time, so I'm going to power through 30 minutes of just kind of demoing all these design patterns. I have a few slides. This is less important than security, but I think it's still super interesting to walk through these different steps. So within Maker, you can do quite a lot. The contract itself is from a long time ago, so it's been around for a long time, but these types of boosting and repay, these are all single transactions that cascade into pools and that allow for swaps into multiple. It's a single transaction that's composable across multiple events and function calls. And so if I wanted to boost something, the idea is to first you borrow DAI from the CDP itself, and then you swap it with ETH with whichever mechanism you want to swap, and then you supply ETH. So what I'm actually doing is with this swap, instead of me, if I wanted to boost this with DAI and I only had DAI in my account, then I can actually supply ETH by using the default swap mechanism. Same for repay. If I only have ETH and I want to pay back the DAI and I don't want to do this in a separate transaction, I can do this in one transaction. There's one way of repaying ETH into the CDP is by using this repay function. Hopefully that makes sense. It's just instead of doing multiple steps where you have to cascade, you're kind of just using a function call that's already exposed. Cool. So instead of sending, this transaction sends DAI to ETH to then send that ETH back in the contract. And then that's different from just directly sending ETH that you might have into the contract as collateral versus directly withdrawing it. And same for the DAI side, right? So the debt side is all about DAI, so I can pay back that DAI directly, or I can do these two, which is just wrapped functions for doing the swap if you're too lazy to swap it yourself. So MakerDAO is for creating your stablecoin, and it's algorithmically readjusting it as needed to give the best rate. It has to be collateralized. Let's look at Compound. And so Compound is for lending, right? So the first thing that you want to do is if you're a liquidity provider, you can open up your position. So you can switch to a smart wallet, which will just use my position. And so if you're long ETH, right, using DAI, you have to deposit both in order to create this position. So this is a Compound position where I can deposit 10 ETH to borrow 5,000 DAI of some sort with some fee. There's always some fee involved. And it'll tell you the safety ratio associated because I'm actually being a liquidity provider. I am providing both sides in order to then get my fees associated with any borrows on this contract. So this is the actual creation of a long or short position on the Compound protocol. If you want to look at what Compound has now, there's total supply of these ETH contracts associated to DAI contracts, USDC contracts. This is kind of the borrow and supply aspect of this. So here I'm creating a contract. Usually you don't do this, but it's just kind of cool to do because you can do it for free here and you can kind of take a look at it. So here I've created now a supply composition of ETH as well as DAI, and then there's a ratio associated for safety. You can enable automated liquidation like in MakerDAO, but the idea here is that you have a borrow limit and you have the amount that you can borrow before you're under collateralized by your Compound loan. And the same aspects apply here, right? I can boost or repay through ETH or DAI borrowing. I can supply more or I can debit more. I'm going to borrow some more because it's kind of good to have a few in here. Something like that. So I'm borrowing more DAI from this Compound contract. Cool. So I've opened the position and now I'm borrowing DAI off of the two legs of the collateral that I've just provided. And what can you do with this? You can borrow and pay back. This is kind of just a loan contract. So I've actually added to the borrowing power. Now there's this amount % available. Now the safety ratio has changed. There's different bots that allow for the safety ratio to be at a minimum. If you go over, then it liquidates. So all of these apply. And this is also super fascinating because this entire thing is done without a bank and without contracts, like physical legal contracts. You're actually creating a lending, vehicle for other parties. Cool. So let's then look at the evolution from Compound into Aave. So what did Aave do that was super cool? They allowed for, also one other thing that you can do is you can stake. Now that you have comp, you will earn comp as a liquidity provider and you can stake it back. So if you have comp tokens, which I can swap and buy, let's use the exchange here. And I'm going to go from ETH to a comp token of some sort. You will also get comp based on being a liquidity provider, but let's just buy 10 comp, 10 of ETH, whatever. So I'm going to buy this slippage tolerance, all these things. You can do this within MetaMask swaps, or you can directly go to Uniswap, all these other places to do it. And then you receive comp, and you will continue to receive comp as kind of earning your interest of being a part of this. It is a governance token. Once you have comp, you can participate in governance. And you can also then stake it back into Compound in itself, which is super cool. So now I can supply into my smart contract position an amount of comp associated to it. So claimable. Oh, this is the claimable one. There's a staking and another one. Where do I stake? Oh, I have to stake through. Anyway, we'll get there. So the next one is Aave, and what Aave did outside of just this loan is they allowed to do basically off of LIBOR. So they're able to provide a price and a spread. There's a migration as well because Aave migrated to version 2. But let's just look at the version 1, which is, you have these different, you can directly supply to a Aave contract without purely creating one. So here, let me just, I don't know why I keep on doing the same amount, but this is a standing contract rather than creating both sides of it. And what I do is that there's a standing Aave contract. I put money into the Aave contract of ETH, and then I can then borrow asset off of the interest rate that they provide, and it can be a stable or a variable interest rate. And that's kind of the difference here, is that I'm not creating the full compound contract. I'm actually just participating in this particular contract. So the Aave contract exists. I can borrow assets associated to it. I can boost. So I can now debit Link, or I'll just debit some USDC, and I can borrow off of that 4,000 USDC. And so you can set your stable or your variable interest rate. The variable interest rate, and you can read through all this, is recalculated. And so I can now have, instead of just a stable interest rate within Compound, now I have a variable interest rate within Aave. And as the interest rate changes, and now there's a known supply, there's a known borrow, and you have that same two-sided aspect of the market here. And so you can see, as I've borrowed, my borrow APY associated to, I have to pay this back in terms of making this all work together. There's also the safety ratio that has to be maintained for the collateral in this space. There's also smart savings. So people who have their money diversified across this can restake their assets in order to receive DAI, or kind of the equivalent of that. And so if I wanted to just supply to DYDX, sure, I'll just put a few thousand in here. What I'm doing is I'm supplying my DAI, which is now my stablecoin, into the DYDX protocol. And all this is doing under Smart Savings is giving an easy user interface for receiving interest for where DAI can be distributed. And so you're throwing in your APY to DYDX because it has a higher return. And this is kind of based on live market data. So hopefully this return over time is associated to it. You can also move between where you're staking. And so this is, again, the single transaction that's composable across multiple contracts. I can move my amount from DYDX to Aave if I wanted to, and I can move a set amount of DAI to there. Obviously, all these have fees associated to it, so it's not a good idea to rebalance all the time. So now it shows I am rebalancing by sending a transaction that moves my money staked in DYDX over to being staked in Aave. And receiving multiple types of returns in DAI associated to it. So there's just interest that's kind of back into it. You can also withdraw from all of these. You can also import. But super interesting way of using your stablecoin in order to diversify across different high-value APYs. And then the last part here that I wanted to share is something new that they just came out with called Recipe Creator, which I think just is so cool. I mean, it just shows composability at its best. So if I wanted to, for example, supply dye from maker to compound, you're sending a single transaction. You can look at more details. These are all the steps that it does for you in this recipe. So you can imagine this with IFTTT, where you're trying to create, if this, then that, and then make these changes. You can create a recipe that sends a single transaction that activates all of these different aspects. So you can use multiple protocols, and you can actually send a single transaction that will create the vault, wrap the ETH that you already have in the vault, supply the collateral from you to the vault, generate the DAI that I just did, and then supply that collateral directly to Compound. So things that took me, multiple clicks and multiple transactions can be done in a single transaction with one of these recipes. And you can edit it, you can automate it, you can kind of create all these different interesting things around it. For example, this one's mining. So they do a flash loan through DYDX. You supply your collateral to Aave, and then you borrow from Aave version 2. And this is probably version 1 to version 2. And then you loan paybacks. You're actually just very quickly creating a fully leveraged USDC position. So very, very cool stuff. A lot of different ways that you can compose across multiple smart contracts that are kind of published as these protocols. You can mine comp rewards through flash loans. So flash loans are super interesting as well. I think that's fairly advanced. These are the ones I wanted to demo because I think it gives a good idea, and feel free. Like I said, this is a simulator. This is all free to use. You can create recipes. You can automate all this stuff, but this kind of shows the value of DeFi. I think we should give these demos more often if we're pitching DeFi. Imagine being able to do this within financial services. I don't think it's possible because there's just too many APIs, too many people offer different rates. The data isn't there for market data. But being able to have this consistently with the market data consistent, and with kind of all of these factors that they're not just open banking APIs, but they're actually open protocols that you can just send transactions to, is super powerful. That's kind of the whole point of why we're in DeFi. Okay. Any questions on this? Yeah, boost. It's good slang. All right. So I'm going to control F5. Oop, cancel this, wrong one. Cool. So definitely play around with any of the simulations. I think most of them have wallet simulations. So you can look at InstaDApp, you can look at Zapper. I played around with all of them. I just thought DeFi Saver was the easiest one to understand because it's separated out into these individual protocols, and they kind of mold them together quite nicely. And these are also kind of like the OG protocols out there. So it's good to see through it. Okay, so what is the magic? And if only people knew this more, is that there's only one design pattern and everything is a DAO. And so what I mean by that is you can input what variation of token that you send to the contract, which is more or less a registry. And your transactions are filled with ETH for gas, but also can be filled with your account, sending from your account to another account. It calls a function, and usually if you're just buying off of an ERC20, you're locking up your ETH in order to get added to the registry. There's a mapping at the top, and more or less when they say that you have a new coin or you have a new token of some sort, your wallet is just reading from this registry to say, hey, you have a mapped balance. And so everything is a DAO. Everything has different levels of business logic, but the quote unquote output is really just you reading from the token registry of what you have. And so any ERC20 token, your retrieval process is the same, very similar. You just kind of read from this contract and you can see what you have. So everything is just locking up your tokens and then updating the state, right, of some sort to say that now the state has, my name with an amount next to it in the mapping. Cool. And so what is different for every contract and every protocol is the functions that you write to cascade. And so you have different types of business logics that you can add into there. Maybe there's dividend payments associated to it. Maybe there's different types of event triggers that you can have, so other protocols can call it. Maybe there's different types of primitives that you can add. I think underrated is pricing. So what prices do the services provide in terms of different interest rates, and then how are the prices calculated based on the volumes of storage inside of the ETH locked versus the different contracts. And so everything is a DAO, but there's also a lot of different smart contracts that call each other in order to kind of separate which is locking up what type of ETH and for which reason. There's wrapped ETH, there's a ton of stuff. There's just so many things to learn. But if you just kind of keep this basic concept in mind, I think it makes understanding Ethereum much better. Is that your transactions that you send, that you sign from your MetaMask, is really just interacting with a specific address exposure. Those interfaces give you a mapping of some sort. So your exposure to it is really just reading a bunch of registries and saying, well, my portfolio is a bunch of token registries. Cool. So I drew this diagram fairly recently, testing it out now, but hopefully it shows you the evolution of TradeFi to CeFi to DeFi. And I use JP Morgan and MasterCard because they're both supporters and stakeholders now. What you can do is you can start with JP Morgan and connect your accounts to Coinbase, right? This is your fiat bridge. A fiat bridge likely uses Plaid or some other open API that maps to multiple banks of some sort. So your Coinbase has then been, you are KYC through Coinbase, you are connecting your fiat bridge to there, and you're just sending a wire transaction between the JP Morgan account to the Coinbase account that's sitting on their end, and then whatever it gets, you get money through there, right? You get credited money. What you can also do is use MasterCard or some credit card. Credit card payments are directly sent to your commercial bank, and then you pay them off as needed. But you can also pay for stuff, which I don't recommend directly to buy, just because you can use the Wire API or whatnot to get actual fiat into your MetaMask. It is traceable, but not as traceable, I guess. I don't actually know how this works in terms of taxes, where you've just purchased crypto through your credit card company. But I don't know. I always like using a centralized entity. I think the fees are pretty high, the basis points that you get kind of directly buying with credit cards. So it's up to you. But that's an option of on-ramping to DeFi. From CeFi, you purchase from USD to stablecoin or directly into ETH. And then from ETH, when you exit, you're doing a token transfer. So they probably create your wallet on your behalf. And then when they actually need to send it, they send it from their Coinbase set of smart contracts that, or different accounts that they have that hold that particular currency, that particular token. They may charge a fee, they may not, but they send it then from their whichever set of they probably rotate between or rebalance between different types of accounts, and they send it to your specific address. There's a recent OCC ruling, some type of regulation that said that they wanted to make this more KYC'd. So they wanted to require people to label where they're sending it to, and then use that for taxation purposes. So then you can trace, if you send something out of Coinbase, then you can start tracing where it is throughout its ecosystem, so you can collect taxes better, more or less. Cool. So your MetaMask wallet has a bunch of tokens inside of it. Remember from before, you're just reading from these different registries, and it says your amount based on your address. And so what can you do with DeFi? And we just showed this, but I think it's easier to view here. If you have ETH, you can stake it. This is just an example. You can do ETH2 staking, and you just receive more ETH based on the perpetual bond curve of ETH2. You can also work with other chains that give you something ETH, like BETH, if you're working with Binance and they're staking. And this just represents the interest that's supposed to be mirroring the amount of ETH that you get. So they're just exposing you to the market rate rather than directly giving you ETH. You can also be a liquidity provider, an LP. So that's what I showed first, which was I can throw in some ETH and some DAI together, and then I can borrow DAI off of it. I receive a C DAI token. So a C token is a lowercase c token, is the creation of a token off of this contract that represents your interest rate. So all of your fees that you collect is through C DAI. And some people start staking CDAI. I don't personally do that because it gets a little bit messy. If you ever want to withdraw out of comp, they require you to have your CDAI authentication in order to withdraw. So you have to send back that CDAI in order to get your ETH and DAI out of the contract. Same for lending. I can throw in a bunch of DAI and then I'll receive a interest rate of DAI back. And then I'll also receive comp back because comp is their governance token, but they also use it as an earning reward for lending. And so that's kind of your interest rate as you receive your DAI as well as comp. And then you can do things like yield farming or staking for liquidity providers, which is using some type of farming token where you throw in your CDAI, which is now a liquidity provider token, and then you get more of something else. And so this gets pretty complicated. You get cascades and cascades of different types of staking. Everything is a DAO, but also everything is staking in my mind. So everything's just throwing in money into some contract and then receiving a new token that represents a new financial primitive, which is super interesting because then you can restake that into other things and you kind of get this cascade. If you want to, you can buy all these tokens. So you don't actually have to go through this process. If I wanted to get exposure to CDAI, I can just swap it. So that's kind of cool too. So I don't actually need to go through the process of working directly with the protocols. I can just get spot exposure to comp by buying comp directly. And people that want to sell it because they have extra comp from earnings can sell it at a premium. And so that's also a good thing to do. They can also throw it into Uniswap and kind of be a supplier in Uniswap. You can also just buy an entire portfolio. So this is a set protocol portfolio, the ETH RSI APY. You can just buy this, which gives you exposure to the entire set of, I think this is ETH with DAI as well. So it's kind of pretty interesting. There's a way to get exposure to that. Okay, just want to show composability. These are all this is the UML output of the maker contract, and you can see token base, different tokens around, different ERC20s associated to it, different function calls. So it's just super interesting. Are there other? It's the easier to understand. So sorry, I mean, I could probably write out what all of these means, and maybe I'll do that as a follow-up. This is also something that is discussed within enterprise and institutions. I know I have 5 minutes left. I'm going to try to rush through some of these. So maybe I could do a follow-up on this because I do have like another hour of material that I can probably go through. Cool. Anyway, instead of going through this, I was going to walk through some of this, but you can go pretty far down the rabbit hole by a trader that's kind of using CeFi into going into DeFi. And maybe in the follow-up, I'll go through what these steps are and try to do an FAQ across all of these just to show the composability. This is actually pretty important, which is, your farming, you can direct swap into all of them that I just mentioned, but you can buy ETH, you can stake ETH, you can buy DAI through swapping, you can mint DAI through collateral, you can earn DAI through staking into comp, and then you can use DAI to buy stuff later on. You can then also buy comp, which is related to DAI through swapping. You can earn comp through staking DAI. And so you can imagine all of these different combinations, and that's why yield farming is super cool. And I know yield farming is used by different terms, and I just see it as this composability altogether. You can use comp for voting. You can buy SDAI associated to it or CDAI associated to it. It's just a bunch of really interesting things that come out of it. There's synthetics pulled together. What I wanted to show is 2 more steps. One is that these DeFi patterns are kind of what we sell into the enterprise world. So payments and money has more or less CBDC as a reaction to DeFi, reaction to digital yuan, reaction to Diem, all of these things, and thinking about M1 bank tokens that don't involve the central bank and all these parts. DeFi patterns of composability, the XYK liquidity model, which kind of supports the pricing associated to it. Tokenization products through traditional real world assets going into tokenized assets, different parties becoming custodians or marketplaces themselves, the whole NFT craze. And then within protocol, I think the whole team knows about kind of the growth and scaling and privacy, as well as interoperability and general baselining, or kind of using the technology for common frames of reference. I have final thoughts. So I would just say that this is a hole that people can get into when they invest in this. And I kind of want to go back to that investment versus gambling slide. My parents worked really hard, and they kind of want me to do the same. And so, like, if you're just obsessed with the market, you're really just counting your money. And so I would just say to enjoy experiences, don't get caught in this race, whatever it is, and also reflect on your legacy. I've written a post about this, about perspective and reflecting on legacy and kind of the stories that you want to create and what you want to pass on from a digital perspective. And I can talk more about this as well. The two things that I want to mention, this is just more for the internal hackathon. I've been brainstorming this for quite a long time and thinking about an HR crypto module. There's a few one-pagers here. I won't go into too much detail. There's also a crypto will and trusts that is kind of like a 1.1 idea subset that I have thoughts of how to kind of push this through. So if you are interested in building this, I have kind of the framework set up for what I want to achieve within the hackathon, and happy to get more people working with me on this little project for a week.
Awesome. Yes. Thank you, Clemens. Good timing. And I think that would be amazing for a part 2. I think tomorrow we'll work with you. Maybe we could get that set up. And then everyone, make sure you're on the ConsenSys Hackathon 2021 channel, and we'll post out to you when that workshop is available. A lot of great content. Just a quick wrap up here because we're right on the minute, and this is good timing. As he mentioned, please go to click on the button below. That'll take you to that Confluence doc. If for some reason you're not able to see the doc on the Slack channel, we have posted all the separate links. So signing up for the actual hackathon week, RSVPing for the workshops, claiming your swag if you haven't already. All those are there. But the Confluence doc also has a bit more information, and get in there, and then that way you'll have a chance to maybe work on this project with Clemens and any other projects that we'll be posting that have been coming through, so that you guys can vote and choose on the ones that you want to join a team to hack on. And if you have an idea yourself, please sign up with that hackathon form, and you can be able to submit that idea, and we'll help you put a team together. So thank you again, Clemens. This was an amazing workshop, all great content, all the stuff that we're wondering about. That's why you need a part 2. Great advice. And thank you everyone for joining us today on this CrowdCast. Hopefully we'll see you on the next one. And like I said, stay tuned on the Slack channel, and we'll keep you posted on all the happenings. Thank you, everyone.
Thank you.